Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our expert there, Senthil Manikandan of Newberry Capital, Forum Parekh of India Bulls Ventures, and we also have independent investment advisor Vivek Mawani, who joins me on the show. Thank you to all of my guests for joining me. Today on Hot Money, we'll discuss ICICI Bank and the numbers that came out. Jubilant FoodWorks also came out with numbers, whether the growth or momentum trajectory will continue. Metals as a space has seen a lot of selling, but is it hit the bottom yet? Is there more potential downside? And FMCG sector, if you're looking at the numbers that came out, the numbers don't seem that impressive. So what we are asking our guest is that are these numbers which have already come out in the FMCG sector, and a lot more will come out, are they showing signs of stress for the sector? So that's the questions that we'll be asking our guest on Hot Money today. Let's start with the first one, and that is ICICI Bank. Came out with numbers, a decent set of numbers, but ICICI Bank has cooled off from the highs of the day. Along with the results, there was this entire issue of the Shri Krishna report that came out in terms of in terms of Chanda Kochhar, and then the board asking Chanda Kochhar to give back the bonuses for the past 10 years. But what's the view on ICICI Bank? Will the hierarchy in picking stocks in the private sector bank change after strong numbers from ICICI and Axis? We'll ask our guests. So, Vivek, firstly, what did you make of ICICI Bank's number? Has the stock run up to factor in all the good news, or is there more potential upside?
Well, there certainly is more potential over the next 6, 12 to 18 months. But fundamentally speaking, the worst seems to be behind it in terms of bad performance, especially on muted loan growth and NPAs, which was a problem that ICICI has been having for the last 5 years or so. So now what we have with the new CEO and MD Sandeep Bakshi is that accelerated provisioning more than what is required. Number one, cleanup of the books in terms of recognizing all of the problems. I mean, most important in terms of solving any problem is recognition of the problem rather than shove it under the carpet. So that's something that the management needs to be congratulated about. Going forward, what we now see is, even if we assume a loan growth which is conservative, I'm assuming 10-12%, the street expects probably about 15 to 18% range, depending on whose estimates you would look at. Even if it was 10-12% with control over slippages incrementally. So even now the gross NPAs are just about 5.5-6%, and if 10 to 12% loan growth, some recoveries, some a bit of greater control on slippages, what we will have is NPAs comfortable within 4-5% in the next 2 years, or maybe 18 to 24 months. Return on equity from what is about 10-11% coming to almost 15%. On a standalone, just the bank, it trades at about 2 times price to book, consolidated including the subsidiaries, the larger subsidiaries of course being the life insurance business, but consolidated including all subsidiaries, it's about 1.5-1.6 times. Certainly is not expensive, even at about 360-370, that range that it is trading at. So valuations do give comfort after the changed scenario. But the stock has of course run up in the last 1 year from about 260-270 levels to 360-370. It's outperformed most of the other banking stocks as well. So probably there could be some, I would say, pullback, sort of a correction after the sharp rise. But I would be a buyer on declines, certainly as far as ICICI Bank is concerned.
Okay, that's the view that's coming in from Vivek. Forum, what have you spoken to your, what have you told your, clients in terms of what to do with ICICI Bank?
Yeah, so first if we look at the numbers, if we dissect on every parameter, it has come, very nice, and it has beaten all the expectations. I mean, earlier we were a little skeptical about it, whether they would be able to, meet their FY20 targets. But now if we look, even on a sequential basis, the NPAs have slid down, considerably. So that is a good sign. and slippages have come down, even on a sequential basis. Even if you look at the loan book, the retail side loan book is growing at a good pace. And I think on every parameter it has stood tall. And now the confidence rises that, as I said earlier, that they want to bring down their NPAs to 1.5%, I guess, by FY20. So that is what they would be able to do so. And it is very much on the track of recovery. And with all these things, I think they also want to have their return on equities, stooding up to like 15%. So everything seems to be in control now. We don't see any kind of whipsaws where one quarter they're going to give good set of numbers, another they would not deliver. Those kind of whipsaws are not there, and there's a clarity now that it would deliver ongoing a good set of numbers. So we are very positive, and we have advised our clients to buy on every decline.
Okay, that's the view of Senthil. What's your view on the ICICI Bank? What did you make of the numbers?
So Q3 numbers were in line, I could say, both on the asset side and the liability side. Particularly on the liability side, we have seen the CASA growth, which was multi-quarter high, and with the CASA of now stands around 49%, was good. On the asset side, we have seen the retail loan book growth of 22% and domestic loan growth of 14%. So all these are at multi-quarter highs, and new management coming in, and the provision coverage ratio is pretty high at around 78%. So much of the stressed and NPAs has been provided for. So we remain neutral on the stock, both on the Axis and ICICI on the corporate facing side. I continue to prefer the private sector peers on the banking sector. Even though the valuations we see, I think both Axis and ICICI trades at a considerable discount to the private sectors, but we have to wait and watch for next 1 or 2 quarters to see how the numbers flowing in, whether both these corporate facing banks are able to grow their loan book, and also whether the slippages which are moderated in the Q3 also going forward. Next 2 to 3 quarters, we have to see how the slippage is also going. So we are neutral on the corporate facing.
Okay, before we end our forum, just a follow-up question now with ICICI and Axis both reporting strong numbers, while the likes of the heavyweights like the HDFC Banks, Kotaks and IndusInd not too impressive. Are you recommending a switch to these two banks compared to the other, or would the earlier, as he pointed out, the bigger private sector banks which and the larger high-valued private sector banks, that would continue to be the top picks?
So no, we also feel that the larger private sector banks like HDFC, Kotak Mahindra should be there in the portfolio. Now there is a juggling between Axis Bank, ICICI Bank and Yes Bank. If we see, all three of them have a change in the management, and all three of them are trading around same valuations. So out of a pack of 5, the pecking order would be like HDFC first, Kotak second, Axis, ICICI and Yes Bank. Okay. Since we have a new management coming at the helm, we do not want to exclude Yes Bank from the portfolio. We feel that Yes Bank also augurs a very good buy at current valuations. That is why we would want to include in the buying list, but we would not want to give high weightage in the buying space.
Okay, so that's the view that's coming in on ICICI Bank. It's trading pretty much close to the day's low. Nevertheless, I think the optimism still remains as far as a portfolio pick is concerned. The other one is Jubilant FoodWorks. Now it's been range bound. It hasn't reacted as widely in last quarter compared to what we've seen over the past few quarters. It's managed to move up, but it managed to tick all the boxes, be it the top line, bottom line, margins, or even the same sales SSSG. But now, will this growth continue on a base which is getting higher, and valuations at close over 55 times this year earning and almost 40 times next year earning? Is it something that would be worth looking at? So Forum, Jubilant FoodWorks, what did you make of the numbers? Are valuations compelling enough even at this level that growth takes priority over valuations for Jubilant?
Yeah, so if we look at the numbers, I think numbers have come very well on every parameters. SSG has come little moderate, but then it was a known fact that it would not be able to sustain such a higher growth. And I think what has worked very well for Jubilant is the margins expansion, and that is because of acquisition of a new beverage company, and also Dunkin' Donuts, which was expected to become profitable in Q4. I mean, yeah, it's done a break even in Q3, which very much says that management is walking the talk. And going forward also, yesterday in the con call, management did hinted that there are going to be short-term pressures in the same store sales growth. But then as we know that management is walking the talk, and they did indicate that it's just a short-term pressure and not a long-term pressure. Hence we feel that one should definitely look at Jubilant FoodWorks, because we definitely feel that this kind of growth is sustainable, because the demand, the longevity and the demand, if you say, it's immense, and they are continuously exploring new cities and new geographies, which is definitely going to attract tractions. And even if we see its online app, it's been able to fetch good orders from the online app, and I think the segmental revenue coming out from the order online app, it's like more than 70% of its tractions it gets from there. So all these things augurs very good, and we feel that all these things being kept in place, the new product innovation and online orders, and all these things will continue to augur a good growth rate, supported by margins expansion. Hence we feel that premium valuations is justified purely on the case of longevity and demand scenario.
Okay, Vivek, you agree, or you finding valuations steep for Jubilant and would avoid?
Well, valuations certainly are high, but what we have observed across sectors, across stocks in the last 1 year, whether valuations have been high across the board, but companies that can deliver quarter after quarter consistently in terms of growth rates, those valuations continue to stay at elevated levels. Companies who have disappointed and delivered growth or expressed an outlook less than what the market is factoring in terms of future growth, those stocks have taken a beating, and multiples have actually taken a beating in those cases. Obviously, Page and DMart and iSure come to mind. At least in case of Jubilant, at least at this point of time, that doesn't seem to be the case, because it's proved repeatedly, it's proved the skeptics wrong whether the growth is sustainable. They have got the building blocks for at least a sustainable growth in the medium term. So at least when I say medium term, I'm talking of the next at least about 2 years, 6 to 8 or 10 quarters in terms of building blocks in place, in terms of new store expansion, new products or new menus, growth in volumes on its own app, which a shift away from the online delivery portals, and so on and so forth, leading to margin expansion as well. Now, is that sustainable? Most of those are sustainable. At least the momentum, growth momentum is strong enough to sustain. At about, as you mentioned earlier, 55 times current year earnings, about 44, 45 times next year earnings seems steep, but if they continue to deliver these kind of growth rates, maybe these multiples will also sustain. Let's not forget there's a stock that also generates 70% return on equity, generates free cash flows, and is a debt-free company. So it has got all the attributes of a stock that probably deserves high multiples. The key risk is if the growth hits a roadblock, then probably these levels as well as the multiples can come at a serious risk. But in the near term, that doesn't seem to be the case.
Okay, so that's the view on Jubilant FoodWorks. Senthil, what about you? Which are you agreeing to what the other said, that valuations are steep, but no doubt growth will overtake valuations? What's your view?
Yes, on the business side we are quite positive.
Okay.
Because if you look at the two business only, the pizza business continues to grow. If you look at the SSG growth of 14.5% for this quarter is on a top of a 17% growth last year. So they continue to grow on the pizza business, and the Dunkin' Donuts business, if you see with the new management coming in, since the new management coming in, they have closed down nearly half of their stores. From the peak of around 77 stores, Dunkin' Donuts is down to 32 stores. And in this quarter, Dunkin' Donuts has made a break even at the EBITDA level. So there has been a lot of restructuring happened at both the business level. And also margin improvement this quarter, I think partially it has to do with the subdued raw material price. I think we have seen the dairy prices have been quite low. I think that could also lead to a margin expansion in this quarter. We have to watch for next 2 to 3 quarters how the margins, whether they're able to sustain the current margins with the promotions they have to offer to compete with other players. On the competitive scenario, we are seeing the intensity has increased year over year. Because if you see Zomato started in 2018 with a monthly order of around 3.5 million, but now it has grown up by 8x over the 1 year. So the with Uber Eats and Foodpanda coming in, I think the delivery space is becoming quite competitive intensity. So in that way, I think sustaining the SSG is a question mark, and the valuation is also not attractive at this point of time.
Okay, so that's the view that's coming in on Jubilant FoodWorks. Let's next talk about the metal space, and metals as a sector which was having the frenzy of last quarter has suddenly cooled off. Counters like Tata Steel, JSW Steel, which were considered bellwether, especially JSW Steel, which is hitting record highs, is now trading at a 52-week low. So there is enough pressure. But the way we are asking is the pressure now off? Is it a good time to start accumulating these stocks which have corrected 20, 30, 40% from the highs? So that's the question that we are asking. So Senthil, I'll start with you only. Any of the metal stocks that you're recommending to your clients now?
Not a direct exposure to the metals and mining sector, because with the macro factors like China trade wars and China slowdown happening over there, that is making a huge impact on both the metals and mining sector. So we have an indirect play with the exposure to AA engineering.
Okay.
So that supplies grinding media to these mining companies. So it operates in a duopoly market, and if you look at the margins, they will be able to sustain at a EBITDA margin of over 25% and a PAT margin of around 17%. This is operating in a mining sector, and it's a debt-free balance sheet, and ROE is also around upwards of 25%. So going forward, we expect a volume growth of upwards of 20%, because the product that AA is offering is high chrome grinding media. So currently the proportion of high chrome grinding media to the total grinding media is just around 20%. So we expect the volume growth to increase for the entire industry, and particularly the company is also doing a capex which will be over in next 1 year. They are also venturing into mill liners, additional products also. So we have this indirect play on the metals and mining.
Okay, no straight exposure. You still feel there's pain that could come in on the metal sector as such?
Yes, even though the valuations have corrected for most of the stocks around from the rise around 40-50%, I think still at the EBITDA level we are seeing still more pressure will come in. So valuations will normalize over the next 1 year. So we are not quite positive on the.
Okay, what about you, Forum? Have you all started recommending metal stocks again to your clients at this level?
We haven't recommended to the clients yet, but then if we look at it, we feel that the risk reward ratio is quite favorable right now. Okay. Most of them are trading near its 52-week lows, and the global tension between the US and China trade war seems to be de-escalating, because even in the past we have seen that there's a lot of fuss about it, and then ultimately it gets cooled off, and we feel that there's going to be friendly talks between both the nations, and there wouldn't be any kind of a worry kind of talks which would be impacting the metal space. And also we saw that the iron ore prices are going up because of the mines which have been closed in Brazil, if I'm not wrong, and that is why Tata Steel and all are going up, because it produces a lot of iron. So we feel that it's a sector to be looked at right now, and we are also expecting a 10% import duty hike on the aluminum from the vote of account, and if that stands tall, then Hindalco augurs a good buy at current rate.
Okay.
So it's a wait and watch approach. There's not kind of a worry that we had earlier in the metal space. If things goes well, there's a talk between US and China, I think in February or in March, and if it works out, then the worst is behind for the metal sector is what we feel. Okay,
worst is behind probably. And Vivek, have you started recommending metal and mining stocks to any of your clients now?
Not really. Two things. Firstly, I'm no expert to stick my neck out on commodity prices, global commodity prices, whether they have, whether the worst is over or not. Because commodity prices, besides demand supply, has got a whole lot of other macro factors, including geopolitical factors like US-China trade wars, which the trade wars seem to be more in the online space, more on Twitter than actually on ground. I mean, that seems to be the funny thing, but it certainly has several experts, including ex-central bankers, have called for a recession, a likely recession in 1920. Probably they are all referring to the US and the Europe and the developed world, not necessarily but China for certain is slowing down, and China is a big factor as far as commodity prices are concerned, because it's the largest producer and largest consumer of most commodities that you can think of, whether metal commodities, non-metal commodities, China is a very big factor. Now, with these kind of uncertainties, I mean, experience tells us that it's best to stay away. Assuming the worst is over and if there's it's okay to miss out an opportunity than to be living with that uncertainty because you really don't know which way the cycle is going. So, so with that in mind, it's a clear avoid, I would say, at this point of time. I mean, there are enough other stocks and sectors to look at which have also corrected sharply, which are also close to 52-week lows and probably making new lows daily. So, I mean, there are enough opportunities elsewhere than to look at the commodities and the metal space.
Okay, so that's the view that's coming in. I think not the most comprehensive positive cues coming in on the metal stock, at least from our guests. So there seems to be more caution that's coming in. Alternate sectors or indirect play on metals is something that can be looked at. And finally, FMCG stocks are something which have corrected. You saw the big cut that came in Godrej Consumer. The counters, like even despite coming out with strong set of numbers, counters like Asian Paints and HUL have also corrected. So is there caution on the FMCG sector? We're seeing the first few numbers that have initially come out. So Vic, FMCG companies, they've come out with their numbers. Not they're okay. They haven't come out with exceptional numbers except for the volume growth. But are the numbers now signing off any kind of caution that numbers are not being delivered and valuations still continue to remain high?
See, here you can't really draw a trend, and although you have mentioned about FMCG, I'll take the liberty to include related stocks in the consumption space as well. And here we have actually two issues. One is whether the earnings growth will continue, double-digit earnings growth will continue. The other side of the coin is the valuations will sustain. So the argument that I had for Jubilant, that experience is that stocks which deliver on earnings, the high valuation multiples are also sustaining. It's only those who disappoint is where there is a problem, where the multiples suddenly take a beating. Now the results so far in the HUL had very good numbers. Asian Paints, ITC, I would include Havells as well. Titan has given some sort of feelers that even Titan seems to be doing well in terms of double-digit growth both in the watches and the jewellery business. Probably on track to deliver about 23-24% growth in Titan as well. The disappointments came from a DMart, Godrej was the other one. Probably even Nerolac Paints, Kansai Nerolac Paints. So you can't really make a trend because there have been select pockets which have done exceedingly well from a standalone earnings point of view, but met the market expectations, and hence post results they have probably not rallied, and there has been some correction in line with the overall weakness in the market. At this point of time, I mean, there's nothing that I can see that suggests that the sector, the consumption space has got areas of concern or to be worried about. I'll also add one more indirect data point. NBFCs who are into consumer lending or who lend for consumer goods also don't seem to be having any kind of a slowdown, which means that the consumer spending on ground seems to be doing quite well. I mean, that's robust. So long as that remains, I don't really have issues on their stock prices.
Okay, Forum, what's your view? Are you cautious on the FMCG space? What have you told your clients on that?
No, we are not at all cautious on the space, and we really like this space because if we look at the numbers, all the leaders, HUL, Asian Paints, ITC, all of them have a higher base, and despite on the higher base, they've been able to deliver good volume growth. And the management knows the fact that they have a higher volume, and that is why it's going to be difficult. Hence, most of the companies are taking steps to increase their volume growth. I mean, we have seen HUL, trying to acquire Horlicks brand, Asian Paint trying to have new capacities on stream. So these are the ways they're trying to, infuse more, volume growth. And we feel that, as I said earlier, even in the Jubilant food, there's a lot of demand on ground, for all these necessity items, which will be continuing even in the future. Hence, we feel that on account of huge demand and Even in the vote of account, we are going to see that there's going to be a lot of populist budget and a lot of steps are going to be taken to infuse the disposable income of the rural areas. So that would also spur to the demand for the necessity items. And that is why we feel that, on any declines, stocks like Asian Paints, HUL, the leaders who have delivered good set of numbers with a good corporate governance should definitely be a buy.
Okay, Senthil, very quickly, what's your view on the FMCG space? Are you cautious? Because I'm asking because HUL, you have for a long time you said that valuations did concern you. So are you still more concerned now, or is that gone now?
Yes, sir. Still on the valuation sale, there is no leeway for margin of safety on any of the FMCG entire sector itself. Because if you see the volume growth for the companies that have declared lesser results in Q3, HUL volume growth of around 10%, Colgate of around 7%. So there is a lot of competition intensity in the sector. It is not such these players can increase price as to their wish. So with earnings growth can be maximum 13 to 15% earnings growth. But if you look at the valuations, almost all of them are trading at decade high valuations. So I think the scenario is it is very much similar to the Nifty 50 stocks for in US, what it happened over the last before 30 years back. So at the time, almost all the consumer facing stocks in US used to trade around 70 times, 80 times. But the crash led to most of them falling 50-60%. So it is not that the FMCG players or a safety stocks or a dependent stocks. Most of them will fall because on the heavy weight of valuations. So just because of the valuations, we are remaining cautious on the pack. Okay, so that's the view that's coming in. I think Senthil is remaining cautious, but that's not the other case with the forum as well as Vivek. But with that, it's a wrap on today's edition of Hot Money. Many thanks to all of my guests, Vivek, Forum, Senthil. Thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.